Hello and welcome back to Options Arena by True Options Masters. I'm Mike Mercer, your managing editor, and what the hell is going on? The stock market just dropped almost 5% in a day. If you're looking at the NASDAQ, about 4% for the S&P. We're recovering a little bit today, but this, of course, comes on the heels of the latest inflation data. The CPI came in higher than a lot of people were expecting, which means higher interest rates potentially in the future, 75 basis point hike likely at the next meeting. Some people are even talking about a full point hike at the next meeting at this point. It's a weird time. It's a scary time. I had to get our True Options Masters on the line to discuss this with us, to tell us where they see CPI going in the future, what they think the Fed's going to do, and how they think the market is going to react. So I won't waste any more time. We're going to get right into it. And this week, I want to start with Adam O'Dell. Adam, what do you think is going on with CPI, the Fed, the market, and how it all connects?
Yeah, so obviously trading CPI prints is going to be a tricky business. If you're a short-term trader and you want to do some options, either long straddles or some type of a volatility trade, you can get a little bit of it. But there's a lot of risk in getting chopped up. We saw that in this week's print where futures were up about a point and then everything dropped 2, 3, 4 points throughout the day. So I'm really thinking of a longer term trade, and really it's based on the thesis that I believe that inflation is here to stay and that inflation will persist at some high level much longer than the market has priced in. So I'm looking for trades that don't necessarily need inflation to continue to rise or for interest rates to continue to rise, but it's really a time trade. Is basically as long as more time passes with interest rates and inflation higher than expected, who will do well. And right now I'm looking at oil and gas companies, oil and gas producers. Basically, have been in a bear market since 2008 and the 2011 top. So basically over a decade, falling prices, a lot of unprofitable, fracture wells, and a lot of producers have just really cut back on CapEx, whether it's through ESG, not wanting to invest in oil and gas companies, or just the companies themselves not wanting to drill unprofitably. There's been a huge underinvestment in the oil and gas industry. And, oil and gas still accounts for well over half of the global energy source. So basically, it's a big ship that is not going to be turned and replaced on a dime with solar and wind, even though those have higher growth rates. So if you look at some of the oil and gas producers, they're now making record free cash flows. And I think that's going to persist for a number of years. So some trade ideas, basically just some diversified ETFs. If you want to go into the oil and gas service and equipment, that's XES, the SPDR equipment, that basically I think is going to be a later term play. Basically, it hasn't kicked into gear yet. The P/E ratios are still high because the earnings haven't kicked in. But I think that as these producers start to do, have a lot more free cash flow quarter after quarter, then they're going to start investing in more equipment and more drilling. Or you could just go straight for the producers. The SPDR XOP would be the ETF, the producers. If you want to go globally, there's an iShares Global Energy ETF IXC. So that'd be another way to play it. But basically, XOP is trading at just under a 6 price to earnings ratio. So even though it's up, almost 40% year to date, one of the only industry ETFs that's up this year in this bear market, I still think that the valuations are extremely attractive, and earnings per share are forecast to grow upwards of 20% for the next 3 to 5 years. So I definitely think a diversified play on oil and gas producers. I do run a service called 10X Fortunes, where we try to find individual stocks that can go up 1,000% or more in a year or so. And I've just this past month recommended an emerging markets producer that is basically trading at a 1.8 P/E ratio and for less than 40 cents on the dollar price to book. So anyone is interested in that pick, we've just got into it, and be anxious to share the details on that as well.
Awesome. Thank you so much for that, Adam. Inflation is here to stay. Get long the energy stocks. I think I'm going to go buy a bunch of XOP right now. I'm pretty convinced. Okay, let's kick it over to Amber Hestla. Amber, what is your trade for not being at peak inflation like a lot of people thought we might?
Well, I have a trade idea based on that data, and to get there, we have to connect some dots first. So inflation was higher than expected. This tells the Fed they need to keep going. I expect the Fed to remain aggressive with a 75 basis points hike next and 50 to 75 the next meeting on November 2nd. The Fed's not the only one raising rates. Banks are raising rates for consumers and businesses. So as business loans get more expensive, companies stop hiring and even lay off some employees. This leads to the trade, which is put options on Capital One, COF. Capital One's one of the largest players in the subprime credit card market. About 30% of its customers have FICO scores below 660, a level that contains near prime and subprime users. So these consumers already seem to be under stress, and Capital One reported a 2.26% charge-off rate in its most recent quarterly reports. So for comparison, JP Morgan Chase reported a 1.47% rate, and Bank of America was at 1.6%. So charge-offs will get worse as the economy worsens, and that will hurt the stock even more. COF is already down 35% more than double its sector average. So the pain's obvious, and the pain will be obvious in the next earnings announcement, and that's around October 25th. The October 28 101 put option that's trading around $5 should benefit from that announcement.
Very interesting take, Amber. So you're seeing kind of a subprime credit bust that's going to really affect Capital One and maybe some other credit issuers. Kind of an interesting way to look at the inflation picture. And for one last, I'm sure, very interesting way to look at the inflation picture, I'm going to bring it over to Mike Carr. Mike, what are you seeing out there?
Okay, so the market seemed to be absolutely shocked yesterday by the inflation news. And I'm sharing my screen here. I'm not sure why the market was so shocked, but I'm blaming Cathie Wood. So she's been making the rounds again. She's kind of a prophet of hope. And she's been saying, inflation's dead, don't worry about it. Cathie's been wrong on a lot of things lately, but the market's still buying her story. And as it adjusted to the reality that inflation is here to stay, we really saw a reaction. So what I want to show on this chart here is this is a list of the stocks in the S&P 500 and their one-day percent change. Even yesterday, with the market down nearly 5%, as you noted, Mike, there were some stocks that were up, just 5 of them. And 4 of them are in a consistent sector. So I'm just going to run through the symbols: CTVA, CF, ALB, and MOS. The 5th one was Twitter. That's a unique story. Elon Musk may or may not be buying the company. The other 4 are chemical makers. They're commodity suppliers. So it's the traditional inflation story where we're rushing into these stocks that are going to have pricing power throughout the inflationary cycle. So what we're seeing is that investors are going to move away from Cathie Wood idea that the inflationary picture is improving. In fact, it's getting worse. Based on the data we got yesterday, it looks like the COLA adjustment for Social Security is going to be about 8.7%. The offset for the healthcare premiums looks like it's going to be 0. So that's 8.7% raises for almost 70 million Americans. And I know they need the money, but that's going to be money pushed into the economy as the Fed's trying to put a stop to the money rush. Government employees are looking at a big raise also. President Biden's budget says 4.1%. It's an election year. Democrats in Congress are pushing for 5.1. This will affect over 2 million government workers. It'll affect military. It'll trickle down to state. So we have 70 million getting an extra 9% every month. We have another 10 to 20 million government workers getting an extra 5% a month on average. That's a lot of pent-up demand about to hit the economy January 1st. This inflationary picture carries through to the first half of next year. The Fed continues to aggressively raise rates. Amber's idea is great with Capital One. Yeah, I think just the pure trade commodities. And I like an ETF. I'm seeing a lot of recommendations for DBC. I prefer PDBC. PDBC is the same thing, but set up a different way so you don't get a K1. K1 is probably the most annoying tax form that surprises investors. So if you can avoid a K1, do so. PDBC allows you to do that. And, a long-term call or just buying whole PDBC looks like a great trade right now. So that's all I have.
Thank you for that, Mike. Very nuanced take. Getting long commodities, predicting rate hikes out to next year as Social Security checks and government pensions continue to inflate the economy, whether the Fed wants it to or not. That's something I'm sure most people aren't considering. Okay, that's going to wrap us up. Thank you guys so much for joining Options Arena this week. You have 3 amazingly different takes. We want to be long the energy, the gas, and the oil producers. We want to be short Capital One specifically. Sorry, Capital One, but you got too many subprime borrowers on your bill. And we also want to be watching out for the inflation in Social Security and get long commodities. Just a quick recap for you. So thank you all again for watching. If you like this content, be sure to give it a like, a subscribe, notification bell. Be sure to check out what Adam Eldell is doing in 10x Fortunes. Check out True Options Masters, Market Leaders as well with Michael Carr. A very interesting ETF selection he has this month. Make sure you're getting your hands on that. And with that, we will see you next week. Thank you for joining.